Okay, everyone. Good afternoon. My name is Ernie Humphrey. I'm the CEO of 360 Thought Leadership Consulting, and it's my pleasure to be the moderator for our interactive panel session this afternoon, Unlocking the Strategic Value of Treasury. Why do I say interactive? On two fronts. What I'm going to do, my main goal is to facilitate an interactive conversation between our panelists, but also an interactive conversation between the panelists and the audience. So please participate actively in this session, because I've always found that's the most value. So I really want you to tap into the expertise of our great panel that we have this opportunity to speak about today. So a little bit of the rules of the road. My goal here is to just facilitate the conversation. So some of the topics that we're going to talk about, just to give you a brief overview of where our journey might take us, and then where you might ask some questions, go over the agenda. One logistical note, we are going to share a slide deck with you after the conference is over, which will have a lot of background slides. So some of the things we'll talk about are risk management, bank relationship management, working capital. There are a lot of slides behind the content here. So I didn't want to overwhelm the audience with slides. I wanted to focus on the panel and the conversation that we want to have this afternoon. So we'll start off our panel conversation around the evolution of Treasury from transactional to strategic, and then we'll probably dive a little bit lower to the ground and talk about working capital, how Treasury is owning risk management, the new realm of bank relationship management, how that strategic relationship has changed, and then how Treasury professionals embrace the role in driving strategic growth, but also most importantly these days is leading across the enterprise. So how Treasury can offer that strategic value by leading across the enterprise. So first order of business, to give you guys a great background of our panel and direct your questions appropriately, I will go ahead and introduce our panel. Our first panel member is Nick G. He gave me permission to call him Nick G, just because his name is difficult for me. So we have a gentleman's agreement there. He's a treasurer of the Associated Press. Nick has over 20 years of Treasury, corporate finance, and operations experience. He joined the Associated Press in 2006. He's responsible for all global Treasury activities, including cash management, risk management, pension plan asset management, Treasury operations, foreign exchange management, and bank relationships. Prior to joining AP, Nick worked at Gannett Company, where he was Director of Corporate Finance from 1998 to 2006. His primary responsibilities at Gannett were overseeing all bank relationship management, long-term debt issuance, foreign exchange hedging activities. Prior to Gannett, he had various positions in Treasury and Finance at Nabisco and RJR Nabisco. Nick holds an MBA in Finance and a bachelor's degree in Chemical Engineering from Manhattan College. Our next panelist is Bruce Lynn, Managing Partner, Financial Executives Consulting Group. Bruce has acquired over 20 years of corporate and banking experience in all aspects of Treasury and financial management by successfully tackling major assignments in areas such as Treasury operations, cash management, strategic planning, credit, Treasury and systems enhancements, as well as design of operating and capital budgets and forecasts. His many consulting assignments have improved the Treasury operations, cash and working capital management capabilities for some of the largest Fortune 500 companies. Bruce has an industrial engineering degree from Lehigh University, an MBA in finance from the Stern School of Business, and is a certified Treasury professional. Finally, Linda Wright, Treasury consultant, former SVP of Finance and Treasurer of Fireman's Fund Insurance. Linda has over 25 years of experience in finance and treasury. Currently, she is doing independent consulting with affiliations with GL Group, the FMCG, Performative, and the Haas School of Business at UC Berkeley. Prior to her consulting work, she was SVP and Treasurer of Fireman's Fund Insurance, Allianz Life, and Allianz of America, managing Treasury, risk management, payments, credit collections, and M&A, the real estate and strategic sourcing for the group. So as you see, we have a very esteemed panel. It's my honor to be up here with them. I'd like to start the first question, which I will direct to Nick to start us out with. The financial crisis of 2008 has helped transform how many companies view the Treasury function. Treasury has increasingly has its hands in the pie in key areas that impact company results. How have you seen the strategic role of Treasury evolve over the past 5 years, and where do you think it's going? Nick?
Yes. Well, what I've seen over the last 5 years is, for the most part, for the AP, liquidity is paramount. It's all about having enough credit available, so if you lose a client, or if you have to make capital expenditures that for our video business, or for another large capital project, then you have to have that liquidity. And the question always arises as what's the best amount or the optimal amount of liquidity that you should have. We're looking at a credit facility coming due in probably 2015, so we're going to be grappling with that, especially with what's going on regarding the pension funding. We have 2 frozen plans, so we did take advantage of MAP 21, so we're looking at a big ramp up on our pension funding. 2008, it was just essentially batten down the hatches, collect money, try to stretch out your payables. It was really a lot about working capital management while you got through that rough period of 2008, 2009, part of 2010. And at the same time, our business, which is mostly we're owned by newspaper publishers, they had a very hard time. So a lot of them went out of business, and it's still sort of evolving right now. Also, it's really about strengthening your bank relationship during this time. You need good banking partners, banks that will stay with you through thick and thin. We had, through our difficulties, some banks stuck with us, some banks bailed. So, with that, you have sort of long memories, you understand the reasoning, but it's really, really very important to have strong banking relationships. You had to be more proactive than reactive for the most part also. You had to try, if you lost a client, you had to figure out, okay, well, can we cut down on CapEx, or how are we going to fund out 1 year or 2 years? It was a challenge.
Okay, great. I think you hit on some great points there. What I think that I've seen as well is that some of the traditional Treasury roles that were viewed as transactional, they all of a sudden become very strategic during the liquidity and working capital crisis. So we'll talk to those, and we'll also talk about some of the other areas where the role is expanding in risk management and other areas along those fronts. So Linda, what are your thoughts on how you've seen the role of Treasury evolve in the last 5 years, and where do you think we might be headed?
Echoing what Nick said, I do think that the capital adequacy, the liquidity pieces are very important. But I also...
It was me. Sorry, I had to get you there.
But as I think about my own career and those of others that I have been talking to in my consulting practice, I'm aware that to the extent that expenses are tight and resources are limited, the attempts to structure, streamline, and automate sometimes are very difficult to accomplish. And so to be strategic, you really need to get all of those structures, streamlining, and automation in place. And make no mistake, if you have your banking operations working properly, everybody's content. You don't get compliments typically, but everyone's content, and you can move on to these more strategic roles where I do think Treasury can make a great deal of difference. Unlike some other financial types, treasurers have a very clear picture of the balance sheet, and they're also skilled in negotiations for financing and such. And those skills can be transferred to other areas like risk management. I think we'll talk about that a little bit later. Risk management more than just insurance buying, although that's complicated enough. And then credit and M&A, and I know Nick has some experience in M&A. So I'm hoping that with cloud solutions and other new tools, more treasurers can get away from Excel spreadsheets and do the more meaty, interesting, and impactful work. So that's what I would add.
Great, thank you, Linda. Bruce?
Well, I think that the companies over the last couple of years have discovered that the Great Recession has brought on a great restriction in their ability to access capital. All of a sudden, the banks decided that tomorrow they were going to stop lending. The $100 million line that you never used, but you wanted for backup, that became either $0 or $50 million. And so all of a sudden, the idea of liquidity becoming important just rose to the top of the pile. Looking forward, I think the things you can count on, if you can count on anything in the future, is that all of that debt that was sort of kicked down the road, that can is still in the road, and eventually you will come upon it again. And will the banks lend to you or not remains to be seen. And if they don't lend to you, then what do? Interest rates, I predict, will go up. You heard it here first. When? Don't ask me. How high? I don't know. But they will go up. So now you have companies that are going to go back to quote-unquote normal. And for those of you with long memories, that would be about 3 years ago, LIBOR was 200 to 300 basis points. Today it's 25 basis points. So if you do the math, nothing else happens and you still have variable rate debt, your interest expense is now double. So you have to look at rising rates. You also have to look at the whole idea of compliance. Economic conditions have been weak. The ability to generate cash flow internally, maybe there, maybe not. So if you can't make the cash flow, you're going to have to sort of buy that cash flow in terms of borrowing if the banks are willing. So the uncertainty factor, and dare I say Europe is not doing so well either, and so you have the euro versus dollar, depending on whether you're receiving money or funding Europe, could add extra costs. So arguably liquidity now has become as important as profitability. And the ability to figure all this out is something that usually falls into the realm of the treasurer. So now all of a sudden Treasury has become as important as selling more widgets.
Great. Thank you very much, Bruce. And Nick, I'd like to ask you this next question. How have you seen your relationship with your CEO and CFO evolve over the last few years?
Well, not use that. What's happened, as I spoke about before, it was mostly transactions were very important back in 2008 through 2010. Just being sure that your cash flow forecast was accurate and that there was no surprises. It's all about not surprising the CFO, as all you folks, mostly CFOs know. And it's really evolved. A part of my role is also pension funding. So I manage on the investment management committee for 2 DB plans, our DC plan in the US, and 2 UK plans. So a lot has evolved over the last 5 years. We've frozen our plans, so a lot of back and forth negotiating with. We have unions also that we have to deal with. So there was a lot of back and forth, but that's finalized, and we have been helped by MAP 21. But as I've said, one of my main goals this year is really looking at pension funding, getting fully funded, and sort of go into more of an LDI strategy on the pension plans, and then looking forward to annuitizing it down the road. But and then it's all about an accurate cash flow forecast, not looking out just like 3 days or 5 days. It's how do you get accurate out to 6 months. And we're not a very large company, so companies that have billions and billions of dollars, I see that it's more of an issue than we're a $600 million company, and it's a struggle. It's all about cash receipts, and you can sort of you have more of a handle on your accounts payable because you can essentially do what you want with that, but the receipts are really a wild card. And we have a large UK company, so we're dealing with a lot of, as APs are global, we're dealing with a lot of global customers who, in most cases, their terms are whenever they want to pay, which is kind of difficult. So my focus is, I've seen my focus, I did have some operational responsibilities in my first few years, but now it's all about cash flow, it's about insurance, making sure we have an adequate level of insurance, and then it's all about pension funding. And also we're trying to get SEPA compliant also in Europe. So there's a lot over the last few years, and what we're trying to do also is use technology to our advantage. So we have 4 folks in our Treasury department, so it's very transactional, so we're trying to go from transactional to a lot of automated systems, and automate a lot of the processes we use so we can do more value add, so we can actually go talk to the business units and say, oh, what are you doing on your website? Let's talk about merchant services, or how the customer's gonna pay for your service. Let's talk about how that website's gonna look. And is it gonna look like Amazon when you buy a book? When someone buys a photo, we want to make it easy, and we want to be able to garner that information, that data, and utilize that data to actually go out and sort of use that data so we can enhance sales even more.
Okay, great. I have kind of a follow-up question for you, Nick, really quickly. So it seems like, the success of what you're doing is really dependent on building relationships, especially across borders. So can you speak to how you've been able to build those relationships and leverage those relationships and build the channels that you need to have open to be successful?
Cross-border is when you say that, you mean on the UK side? And
Yeah, both. I mean, even within your company and also across the borders.
Yeah, so what we really rely on our banks a lot for cross-border. They should be country experts. So we have HSBC, Barclays, and so we rely on them for the most part globally to tell us what's going on in country. So we're frequently meeting with our banks to just discuss country risk, so to speak. And we're all over the world, so it's kind of where we are is I don't know, we're in a lot of the hot spots. So getting money in and out of there is kind of a challenge. Also, we're looking at, we have a small presence in Africa, and we're just trying to go into that market a little bit. Also, cross-border in the UK, we have an accounting team. So there's sort of a dotted line for cash flow forecasting to me in Treasury. So sometimes it's kind of challenging to get the folks focused on cash flow forecasting when they have to close the books at the end of the month or something like that. Cross-border flows are mostly, the way we're set up is we centralize billing mostly in the UK and US. All the cash is funneled back to our main banks. And then we essentially segregate, shoot money out to our bureaus. We have 250 bureaus globally, so they all suck that cash up. And so we're really concerned from our perspective is we have cash visibility to about 80 to 85% of our dollars on any one day, which is fine because we know that the other 20% is just being utilized.
Okay, great. Thank you very much. Bruce, I mean, you kind of spoke to us about liquidity, the importance of liquidity. How would you advise firms define their optimal level of liquidity in this market?
The optimal level of liquidity, I guess, is the ability to pay your bills when they come. That would be the non-technical answer. I don't think there is any one good metric for that, but I think it does bring up the important question that you should have some. Industries are different, but it's interesting when you think about how people measure success. If you were to tell the CFO or ask the CFO about how he measures success, chances are you'd hear answers like EBITDA or earnings per share or earnings growth, which are all really P&L measures. And yet we're talking about liquidity, we're talking about risk, we're talking about treasury. And then you say to someone, well, what's a measure of success of Treasury? I think you'd have enough time to have a short sandwich because there are no real good metrics, and that is one of the problems. How do you know that you have enough liquidity? And I don't think there's any one measure. I think this is the answer. But there's a couple that I would suggest, and one is a simple free cash flow, something that people have promised Street. I know for a fact that you can look at the 10K, it's no big secret that Staples, for example, uses that as one of their objectives. And free cash flow for maybe those who are uninitiated is nothing more than operating cash flow less CapEx, less dividends. And if you have a positive number when you're left over, that cash is free. Although that's, again, relative, because free to do what? If you have debt outstanding, the banks tend to insist that you pay them back. So you have to have enough to pay them back if that comes due. So as a measure of liquidity, that's certainly one measure. Another measure is a simple cash conversion cycle. When is the next time I will get cash, and how many days will that be? Because if you have 10 million in the bank and 20 million in payables, and you're not going to see any cash in the next 20 days or 60 days, you could be in trouble. But again, paying your liabilities when they come due, or having enough cash to reinvest in the next widget or the next bright idea that comes along. Because if you have a business that doesn't throw off enough cash to reinvest in the business, you may be quote-unquote profitable, but you're really in a downward spiral. So I don't know if that's a specific answer, but
Right.
everything's
Sure.
relevant.
Great. Yeah. And then, okay, that's enough of that. I did that on purpose. Oh, sure. Go ahead.
For Nick, how has the organization viewed Treasury over the last 2 years as it relates to risk management different in your estimation?
And we know what the budget rate is, and then we look at actually... we're a news agency.
That's fine.
Those are redundant. They do maybe AP and AR, but they don't do Treasury. Why not? World, if you wanted to operate 24 hours a day, you could, taking into consideration that Australia is always 14 hours ahead, and you get a jump in your competition.
Follow-up questions. One, the concept of having everybody have all of their on their laptop, is that a big security issue? That laptop go missing? And B, whose function to do PCP is it? Is it yours if you're covering with risk management, or the CFO?
Well, it's essentially my responsibility as treasurer of the company. Our laptops are fairly secure as they could be. We use mostly token systems so you don't have everything on your laptop like where you can get into your bank accounts. It's mostly token driven. So you have your tokens in a separate location. Now, you could say that separate location isn't, you shouldn't have everything in one briefcase, or you have the same issue. But we feel that the disaster recovery plan and that our IT actually has adequate safeguards that were fairly secure in that regard.
Great. Just to continue along the risk management line, some of the conversations that we've all had. So I'm kind of educating.
He wanted everyone else's pay to go into the bank accounts. So that got his attention, and with that, I was able to convince him that this was an area worth additional spend. And also, remember too that my last corporate role was in insurance, and an insurance is a promise to pay. So if you've got a party that's troubled and out of his house for whatever catastrophe that may have occurred, he wants that claims adjuster and that money right now. So getting claims paid timely was another strong motivation to get resources dedicated. So it's a little bit industry specific, but I think you can make the case. And in terms of our cash forecasting, I've already mentioned that was quite difficult. And if there were a litigation settlement matter suddenly in the mix, that was a lot of money that had to come out of the normal plan. So that got him to allow me to get involved with the general counsel's office, with whom I'd worked very closely anyway. So
I would just...
Bruce, let me ask you a question.
Sure.
To keep up on this. So in your experience with your clients, are there specific areas, sources of risk that Treasury faces that you don't think they really have a handle on? The clients' exposure areas where they might need to pay more attention, or any areas that are glaring that they don't give enough attention to?
Well, I think Linda mentioned it earlier that if you're looking at risk, I think it's fair to divide it into some different groups, whether it's financial risk or maybe counterparty risk, operational risk, and the idea that you might have market risk. But interesting enough, of those, 2 out of the 3 are really what I'll call sort of an outside environment imposing its will on your company. Market risk, for example. You can't control where the euro is going to go, or even if the euro is going to be around tomorrow. And what does that mean to you? So having plans to talk about that or to hedge that exposure is something that Treasury needs to get involved with. Counterparty risk. Again, I would use the example of MF Global, for example, in which MF Global, as you all know, is the 8th largest bankruptcy in the United States. And you could argue that the system, the financial system, worked very well because as soon as the counterparties found out what MF Global was doing through the regulatory reports that they filed, they no longer wanted to play. And because they no longer wanted to play, they wanted their money back. And when they wanted their money back, that was the downward spiral. So the question is, how much risk is too much? Is a question probably best answered when you put yourself in the perspective of your counterparty, looking at risk from outside in rather than inside out. Although operational risk obviously plays a component there. In the case of MF Global, you had an assistant treasurer pleading the Fifth Amendment to Congress. When was the last time you saw that happen? And that's because MF Global gave people their money back. Well, actually, they gave other people the other people's money back because they didn't know whose money they had. So that's an internal risk, maybe a self-inflicted wound, but again, started by the fact that the counterparties decided that MF Global was too risky, whatever that meant. And that's all you need. That's the classic run on the bank, is really what that is.
Let me follow up with you on an earlier question, Bruce, regarding cash and liquidity. So it seems like, everyone's become more risk averse, and there's a lot of excess cash out there. So can you speak to some opportunities that might be out there for companies, or what you see as what companies might need to do? Do they need to be a little bit more aggressive and kind of come out of the woodwork a little bit?
Well, looking at this strategically, there's only two things you can do with cash. You can give it to your investors because it's theirs, or you can use it to improve your business, and whatever business you've decided to go into. And I think that, and again, in the case of Apple Computer, that was driven home when Apple had to be sued so that their investors could get some of their cash back. They had $135 billion in cash and cash equivalents, and I guess Apple felt that that was not enough to run their business. Again, where their business is going, I don't know. Apple is obviously tight-lipped about that. But the question about how much cash and what you should do with it, I would argue that that cash ought to be reinvested in your business or given to the investors. That's management's decisions to make. If they make the right one, the value of the firm goes up. If they make the wrong one, well, there is, professional and other reasons why you might be wanting to look for another job. So the idea of trying to manage liquidity is just using it to buy the next business. And I would argue today that of the money that's out there, if you are cash, you are king. And the asset values today are low. Why not buy something today? Now the question is what and when, and that's a tough call. But I think just letting it sit there, investors are going to say you have an underutilized asset earning whatever, 10 basis points, 20 basis points in your business. You can return, pick a number, 10%, 12%, 15%. So why are you earning 20 basis points when you could be earning 15 basis points? And if you can't figure that out, give the cash to me and I'll figure it out.
Great. Before I take the conversation on another insurance break, I was just going to ask a question.
Yeah, so let's say you have cash and you're thinking of buying something, acquisition. What would you do with $30 million overnight?
I'm sorry, what would I do with it?
$30 million overnight. I'll take it. Okay. I thought you were going to give me the answer.
Well, it comes back to cash forecasting, and we've talked about this. And again, how much liquidity is enough? There's many ways to look at that. You can sort of look at that from the top down or from the bottom up. If you look at it from the bottom up, you have to say, well, I got to pay payroll. That's X amount. I got to pay my vendors, so on and so forth. So at the end of the day, if that totals to be whatever the number is. Well, I'll give you a perfect example. I had a client that was a private equity client. They were highly leveraged. They had $100 million in the bank, and it didn't take a genius to figure out that if I paid off part of my debt with part of that $100 million, I could reduce my interest expense by X. The trouble was that their cash was in 250 bank accounts in 40 different banks around the world. So to actually even to do that, that was hard operationally. But to figure out how much it took to turn on the lights every day, that they had a hard time doing because they grew by acquisition and had 7 general ledgers. So things beget things, but it comes back to your view of how much liquidity you need and what you should do with that, which is easier said than done. And I think Nick has that in spades because you're in places where I wouldn't want to be.
I guess for you, the question really is, when will you need that 30 million, and what's your time frame? I mean, you can go out and buy, A1, P1 commercial paper, with, you could probably get 20 basis points, or you can go to your banks and some can give you a better rate than others, maybe up to at least 50 basis points. But it really has to do with what your time frame is and when you will put that 30 million to work. I mean, really, that really is the key. You can leave, in some banks you're just doing a better job by just leaving it in the bank and getting the earnings credit rate. So it's,
I think, just to piggyback off of that comment, the first step is to sit down and organizationally develop a comprehensive risk management policy to say, if we did have 30 million, what would you want me to do? Because commercial paper, as one example, can be top rated today and you can get into a habit, and next thing you know, this happened to an organization I was with almost 10 years ago when the California utilities decided they weren't going to start paying their bills, and all of a sudden we had a $200,000 commercial paper with California utility that was worthless.
Have a pile of cash, what you're trying to do here is you're trying to say a certain percentage of that is tactical. I just need it every day to pay my bills. And then, but even coming up with that is tough. But if that is, again, using your example, $30 million, if that's 50% of that is tactical, then you've got $15 million left to, do something exciting, if you will. Hopefully, you would want to look at your business and say, if I put that to work in my business, I can earn 15% or whatever the rate of return is, because any financial asset you're going to invest in should yield you less than what you could do if you put it in your business, or you're probably in the wrong business. And even that could be a signal, because and then at the end of the day, if you don't know what to do with it, or if you think there's nothing there in the next 5 years, then you have to consider the investor also. If you're a public company, I guess, you have to consider the investor. And I think that is, to get back to my example about Apple, I'm not sure that they did that, since 70% of their cash is outside the U.S., and when they lost their suit, what did they do? They borrowed the money. So they had $135 billion in cash equivalents. They had to pay dividends, they were forced to, and then they ended up borrowing. Now, that's a little strange. Yes, it's probably the cheapest way to do it, given the fact that all your cash is on a sack on the roof, and you can't get to it because you don't have a ladder. But I'm wondering if the tax boys thought about that as a cost of their strategy, since Apple is renowned for its tax strategies. So maybe that's another point to when you're trying to do your forecast. It's not enough to have Treasury do the forecast. Treasury has to work with all the other areas. And that is something that is easier said than done in most silo-enabled companies.
Great. Can I follow up with Nick? Has your short-term investment philosophy taken any turns in the last few years, or are you still conservative, or has there been a shift at all in what you would invest in, say, 30 days?
I think we're still very conservative, that we go to our banks for the most part, try to earn better than the earnings credit rate. The banks look at those deposits, but I think a lot of banks have more than enough deposits now that they're not looking for deposits anymore. But we look at that as giving them some additional ancillary business that they're always looking for. And there are banks out there that are giving you 50 basis points, but you need to find them.
Are there any investment vehicles new investment vehicles that banks are selling or others are selling to try and get you an edge out on the yield curve at all? And you can all feel free to comment on that. Have you seen any changes, since it seems like people might be willing to creep out on the yield curve a little bit, people coming to you with any different types of products yet?
Well, I think everybody knows, as Bruce said, that interest rates are going up, so you don't want to lose principal. So right now, you're just sticking with it. You think the stock market, you don't want to put cash that you'll need even in a couple of months in the stock market, because the stock market might be fully valued and then bonds are going to lose money. So you're better off getting, 10 basis points rather than losing, 5% in a month. The CFO wouldn't like that.
The tricky thing to watch out for when you're investing, and getting back to the $30 million example, is if you had $30 million, let's say, sitting in the bank today, the first thing, and I don't know if you can see it sometimes, the banks are pretty clever about this, is you're paying FDIC insurance on $30 million at about 13 basis points. So whatever your earnings credit rate is, let's say it's 20 basis points, you're really at sort of a net 7 basis points. You'd probably be better off, if you're content with the credit counterparty risk of your bank, to buy a bank CD. But then, as was said earlier by Nick, what's your time frame here? Are you going to buy a CD for a year, or are you going to buy a CD for 6 months, whatever? But by buying that CD, you have now taken the money out of your demand deposit account, put it into your CD in this case, and arguably your net interest earnings are higher than they used to be. Now, you have to look at the specifics, but again, you're taking the credit risk of that bank, so you have to be content with that.
Let's go over here, then we'll go over here. So
This question's for Nick. How many banks do you deal with? And are you concerned with the counterparty risk of each of these?
Not really. We deal with only 6 banks for the most part. So we have a very small banking group, and it's a global bank group. So we're not as concerned as we were in 2008, 2009, 2010. I think the banks are coming back, and their tier capital is fairly in good shape. So we're not as concerned about that. Maybe 6 banks. Our facility is less than $100 million, so even you start thinking that, with our limited amount of ancillary fee wallet, is 6 banks even too much? I don't know. It's not. We don't have, our bank fees are fairly limited. Some banks do insurance brokerage, so we're, looking at one of our banks to do that, but, who knows? They got to win that business.
Okay, thank you very much. In the interest of time, we're going to have to wrap up. But the good news is, these are great conversations. First and foremost,